Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate filings. Today, we're diving into a Form 8K filed by the Federal Home Loan Bank of Des Moines. It might sound like a snooze fest, but trust me, the details in this report about debt, obligations, and a key government agency are surprisingly important for understanding the stability of the housing market. It's like finding out your local bakery is actually backed by a secret society of bread enthusiasts. This report is dated March 5, 2025, which means we're getting a fairly recent snapshot of what's going on. Think of it as the bank's way of saying, hey SEC, here's what's new and potentially important. So who is the Federal Home Loan Bank of Des Moines? They're basically a cooperative bank owned by other banks, credit unions, and insurance companies in their region. Their main job is to provide funding to these members, which then gets used for things like home loans and community development. It's like a bank for banks, ensuring they have the money they need to lend to you and me. Now let's get to the meat of the report, the creation of financial obligations. This is where the bank talks about how it's raising money. They do this primarily by selling debt securities called consolidated obligations. Think of them as IOUs the bank sells to investors. The report explains that these consolidated obligations are actually the joint responsibility of all 11 federal home loan banks. Meaning if one bank can't pay, the others have to chip in. This is where the Federal Housing Finance Agency, or FHFA, comes in. The FHFA regulates these banks and can even force one bank to cover the debts of another. It's like having a really strict parent making sure everyone shares the burden. Why is this important? Because these consolidated obligations are a major source of funding for the housing market, and they're only backed by the financial strength of the federal home loan banks themselves, not by the US government. Let's dive into the details in what they call Schedule A. This schedule lists all the consolidated obligation bonds and discount notes that the bank is issuing. Discount notes are short-term debt, while bonds are longer-term. Unfortunately, there are no specifics in this report regarding the exact interest rates or maturities. The report also mentions some important caveats, things to keep in mind when reading this. First, the bank isn't saying that any single consolidated obligation is particularly important on its own. However, the overall issuance of these obligations is definitely something that matters to the bank. Second, the report doesn't cover any interest rate exchange agreements, which are basically bets the bank might make to manage the risk of changing interest rates. These agreements can be tied to the consolidated obligations. Third, the schedule doesn't give a complete picture of the bank's total outstanding debt, because it usually leaves out the really short-term discount notes and doesn't show how the money from new debt is being used to pay off old debt. For the total picture, we'd have to look at their regular financial reports. Finally, the principal amounts listed on Schedule A don't reflect any discounts, premiums, or concessions that might affect the actual cost of the debt. Again, for the full financial picture, we need to see their official financial statements. Alright, that was quite a bit on debt and financial obligations. Let's step back and see what it all means. This report gives us a glimpse into how the Federal Home Loan Bank of Des Moines is funding its operations, which ultimately support the housing market in its region. So what's the takeaway here? On one hand, the bank is actively raising funds through debt, which suggests they're playing an active role in providing liquidity to the housing market. On the other hand, we need to remember that this debt is ultimately backed by the financial health of the federal home loan banks themselves. The involvement of the FHFA adds a layer of oversight and potential risk sharing, but it also highlights the importance of these banks in the overall financial system. From an investment perspective, it's a mixed bag. These consolidated obligations aren't backed by the full faith and credit of the US government, so there's some risk involved. However, the joint liability of all 11 federal home loan banks and the oversight of the FHFA provide a degree of stability. Overall, the Federal Home Loan Bank of Des Moines seems to be operating in a fairly stable environment. The housing market is still strong, which helps the bank's members, and the FHFA is keeping a close eye on things. However, it's worth keeping an eye on interest rates and any potential changes in housing market conditions, as these could impact the bank's ability to manage its debt and support its members. Thanks for watching this episode of Corporate Decoder. If you found this breakdown helpful, please like, comment, and subscribe for more insights into the world of corporate filings. What company would you like us to decode next? Let us know in the comments below.